Kia ora team, Claire here from My Mortgage, and today I want to talk about low equity premiums and low equity margins. So these are called in the banking world LEPs or LEMs. Essentially these amounts do represent the amount of risk that a bank is taking on by lending to someone with less than a 20% deposit. So normally these are charged when you have somewhere between 10, 15 and just up to under 20% deposit, and they vary a little bit depending on how much deposit you have. So firstly, with a low equity margin, generally this is if you've got a 10% deposit, somewhere around about the 0.75% added to your standard interest rate for 6 months, 12 months, 24 months. And if you've got 15% deposit or more, but less than 20, you'll be charged probably around about that 0.25 mark. With a low equity premium, this is an upfront fee. So this is essentially charged based on the amount of money that you borrow, generally around about 0.75%. So for most people, that's between 4 and maybe up to 7,000, depending on their situation. But depends on how much you're borrowing. There is also what we call an LMI, or a lender's mortgage insurance fee, that's added to the loan for a first home loan. So if you fit that criteria, and we've looked at those options for you, then that may be applicable to you, and it kind of amounts to a very similar thing. So these low equity premiums and the margin are normally charged up front for the premium, and for the margin it's in place until you have equity of 20% or more. In order to prove that, we usually have to get an updated registered valuation. You might have done some work on the property, you may have had some capital growth, or there might just be another really good reason why the property has increased in value, or you might have even paid off a lump sum or got an inheritance or something like that. So we need to prove to the bank that the property is worth more, or that you've paid that money off, and then we can remove the margin. The premium, because it's charged up front, that doesn't ever come back to you. So sometimes, depending on your situation and what you've got going on, we might be looking at the margin as opposed to a premium, or vice versa, depending on your situation. So hopefully that's all you need to know about low equity premiums and low equity margins. If this applies to you, if you've just been pre-approved, we will have sent you an email which explains roughly the amount of interest that you'll be paying, or your repayment per week, fortnight or month, to give you an idea about how this will fit in for you. If you are new to the process and you just wanted some understanding of what these terms mean, get in touch with us. We would love to work with you as your advisors and help you out into your first home. Jump onto mymortgage.co.nz/contact and get